Hi everyone, I'm Anthony from Superior Wealth. I've been a financial advisor for over 20 years, and today we're going to be talking about self-managed super funds and whether it's an appropriate strategy for you to consider. So the presentation is only going to be about 15 minutes, so not too long. So hopefully at the end of the presentation, you'll actually understand what your options are as far as understanding how to invest your super savings. So bit of background. First and foremost, obviously a disclaimer, this is about general advice only. So general factual information, it doesn't take into account your personal circumstances, okay? So to start things off, it's a question that I always tell clients. Essentially, if you had $200,000 saved in the bank at the moment in your personal name, how would you actually approach investing that amount? So you can either option A, which is invest it all into the share market, or B, would you use it as a deposit, get a loan from a bank and invest it in an investment property? Okay, so I dare say most of you in the room would obviously choose option B because it's probably a safer option. You probably understand property more so than the equities market. So if that's the case, then why are your super savings invested all in option A? So basically, if you don't have a self-managed super fund, that's what it's actually invested in. Okay, it's all invested in option A at the moment. So self-managed super fund is the only avenue where you can actually invest in a property using your super savings. And I'll go briefly, obviously, to show you how that can be done in this short presentation. So just a quick summary point in terms of the content, superannuation, what's the different types, and the importance of super in general, what's a self-managed super fund specifically, advantages and disadvantages of operating a self-managed super fund, how to buy a property using your self-managed super fund, strategies to increase your super balance if you're a bit short in terms of acquiring your super fund of your property that you desire to purchase. And last but not least, just a quick brief working example of how much you need in order to purchase a specific property at a specific price point, okay? So first and foremost, superannuation. Not the most exciting topic, but it's definitely one of the most important that you probably have in your lifetime because it's probably going to be the second biggest asset that you own once you do retire, apart from your family home, okay? So for a lot of us, we don't really take a proactive management approach in terms of our super at the moment because it's so far down the track in terms of when we can actually access it. But the earlier you actually do it, the better it is. Okay, so it certainly needs to be managed appropriately and proactively, certainly not a set and forget approach. Okay, in Australia, there's four main types of super funds. The biggest is probably industry super funds. So industry super funds are low-cost funds that are specific to certain industries, and Australian Super is probably the biggest one, and that's probably open to all Australians in all different types of industries. But there's other ones like CBUS, HESTA, RES that target specific industries. Like CBUS is for construction and builders, HESTA is for hospitality, and RES is for retail. So those are low-cost funds, basically not much investment choice, and they sell themselves essentially on being very low cost. So that's a very attractive proposition for certain people in terms of reducing costs. But in terms of investment performance, it doesn't really produce the best return. So we really need to consider all factors when we actually choose our super fund, not just on low cost. Okay. Retail funds are also a major super fund type in Australia where essentially there's a financial institution that operates those retail funds. So when I talk about retail funds, we're talking about examples like AMP, BT, Combank. So essentially there's a big bank that actually runs it, okay? So a bit more expensive than industry super funds because they have a bit more resources devoted to managing your investments. And by correlation, they should produce a higher rate of return as well, okay? The third account there is wrap accounts. Wrap accounts are financial tools that financial advisors use where we take over the management of your super fund. Okay, so if you don't like industry funds or retail funds and you're not really in a position or you don't like to set up a self-managed super fund, that's when we actually take over the management in order to try and generate a higher rate of return. And last but not least, self-managed super funds. So definitely the biggest growing type of super fund in Australia. A lot more people are setting up super funds, self-managed super funds, because they want the choice, they want the ability to invest in an asset class like property, which obviously they can control. Because at the moment, if you don't have a self-managed super fund, you don't really have much control and transparency or have much of a say in terms of where to invest your funds. So self-managed super funds allows you to do that. Okay, so we'll go into a bit more detail about self-managed super funds. So what's a self-managed super fund specifically? So in short, a self-managed super fund is a super fund that that you actually manage yourself. Okay, so the objective for all super funds the same. So essentially, it's to maximize your retirement savings. Okay, so self-managed super fund, you take ownership of where to invest your super savings for your retirement. Self-managed super fund can have up to 6 people, so you can have up to 6 people joined up in conjunction to actually operate one self-managed super fund. Okay, and we set up a company to act as trustee of the self-managed super fund. Okay, as directors of the trustee, you're actually all responsible for making investment decisions of the fund itself. So once you open a self-managed super fund, you transfer your existing super fund into the self-managed super fund and invest in an asset that you believe will generate the most capital growth for your retirement. So the benefits, I touched on it briefly, broader choice of investments. So this is the biggest benefit of a self-managed super fund because you can pretty much invest in anything that's classified as an investment. So whether that's property, for most people, probably 90% or more, if not more, set up a self-managed super fund to buy property because that's what we know, okay? That's what we understand. And that's what we can actually choose ourselves and have ultimate responsibility for our self-managed super fund or super savings. Okay, but other people do invest in other asset classes, so collectibles, artwork, stamps, vintage cars, private lending, shares, cryptocurrency, gold bullion. So you name it, essentially any type of asset class, you can actually invest your super savings when you set up a self-managed super fund. Okay, so obviously you have greater control and transparency because you control what you invest in. And probably the biggest advantage of a self-managed super fund is the power of leverage. Okay, so when we talk about leverage, it's about utilizing what you have, getting a loan in order to boost up the investment amount and buying and purchasing a greater asset of greater value. So just similar to the way we buy investment property. So if we have $100,000 saved up, we generally go to the bank, get an 80% loan and buy a $500,000 asset potentially. So essentially with super, it's the same strategy, same philosophy, where we actually use what we have now, get a loan and buy an asset of greater value, which over time, if it doubles in value, we're doubling the greater amount. So rather than doubling 200,000, if you could be doubling potentially a 500,000 or $600,000 asset. Okay, so that's the long-term strategy of self-managed super funds, and that's the power of leverage is only available in a self-managed super fund scenario. So if you're in an industry fund at the moment, you won't be able to get a loan from a bank and borrow to buy a more expensive asset. You can only do that when you have a self-managed super fund. So what are the benefits? So in Australia, obviously the tax rate, obviously we're all aware how much tax we pay. So in super, there's big tax concessions in super. So essentially it's a flat 15% tax rate at the moment while we're all still working under 65 years of age. But the biggest benefit is actually when we actually do retire, whether once you turn 60 and we're retired or you turn 65 years of age, then essentially all income earnings up to a specified amount, $1.6 million, is all income tax free. Okay. And more importantly, once you dispose of an asset, you don't pay any capital gains tax whatsoever. So using that same example again of that property that we may have purchased inside a self-managed super fund, if that's doubled in value and you sell it once you do retire in order to fund your retirement, you don't pay any capital gains tax, which is a big difference compared to owning an investment property in our personal name. Okay. So that's the long-term approach, and that's why so many people buy property in a self-managed super fund environment. And that's why for financial advisors, a lot of our strategies for those clients who are approaching retirement is to transition as many assets as possible from personal name into super to take advantage of the tax-free environment once they do retire. Okay. So we talked a bit about benefits. What are some of the disadvantages? So essentially, because obviously you're taking more ownership of the self-managed super fund, you're taking full control, there's more admin work involved. So you need to be a bit more proactively involved in managing your super savings. Okay, so you need to keep records, you need to pay your taxes, you need to meet an accountant every year, to do tax returns and have it audited to make sure your self-managed super fund is doing the right thing. Okay, so obviously compared to what your super fund, who your super fund is at the moment, that obviously means you have to take a bit more active approach. Okay, and secondly, to obviously set up the whole structure and get your super in a position where you can actually buy a property, you need to pay the financial advisor or an accountant a one-off establishment fee to set up the self-managed super fund. Okay, roughly about $6,000. And that encompasses a lot of steps. So establishment of all entities, super rollover, insurance review, application for ABN tax file number, bank account, liaising closely with the broker and solicitor to make sure the loan gets approved and settled in time. And last but not least, we also form an investment strategy for the residual funds after the property settles. Okay, so for most of you, you probably won't use every cent in the dollar of your self-managed super fund to invest in a property. There's going to be a bit more money left over. So we obviously need to invest that, and we need to form an investment strategy for that residual balance in any funds going forward in the future. So other general points, a lot of clients come to me when I actually speak about self-managed super funds, they say that they're not really equipped to operate a self-managed super fund, or they don't have the knowledge. I mean, generally, that's a bit of a misconception, because essentially, once you do all the right things in terms of selecting the right asset, the administration of running a self-managed super fund is not that difficult. Everything's electronic in today's day and age. So all bank records, all property agent expenses and revenue, it's all summarized in a statement every year. So it's not much harder than doing your own personal tax returns every year that you actually been doing for, since you've been started working. Okay, so it's really not that difficult. And also, just as a general point, you have to have a good record of the ATO to operate your own self-managed super fund. So you can't have any outstanding tax returns from years ago, and you can't really have any liabilities with the ATO that you don't have a payment plan, because ultimately the ATO is trusting you to operate your own super and to control your own super. So you need to have a good track record with them for them to actually grant you that access. But most of the time, it shouldn't be an issue. And even if you do have any outstanding returns or any liabilities in the past, we can work with the ATO to obviously explain to them the situation and how we have a concrete investment plan in place so that don't obviously have any trust issues with you operating your self-managed super fund. So how do we actually buy property in a self-managed super fund? So essentially, we need to set up 4 entities: company which acts as a self-managed super fund. We need to set up the self-managed super fund itself, okay, the bear trust, and a corporate trustee to operate as trustee of the property bear trust. Okay, so we need to apply for an ABN and tax file number. Remember, the self-managed super fund is its own legal entity. Okay, so it's completely different from your own personal affairs. Okay, and we need to roll over your existing super savings into the self-managed super fund. So this is a diagram form of the structure itself. So on the left-hand side is the corporate trustee of the self-managed super fund and the self-managed super fund. As soon as you need a loan from a bank, okay, we need to set up 2 entities on the right-hand side, which is the property bear trust and the corporate trustee of the property bear trust. Okay, so those 2 entities on the right is mandatory as long as you need a bank loan from a financial institution, because the financial institution wants to hold the property as security. They don't want to touch any other assets associated with your self-managed super fund. So for them to actually do that, they need to hold the property separately as long as there's a loan in place. Okay, once the loan's been paid off, we don't need the 2 entities on the right-hand side, and the ownership of the property automatically transfers back to the self-managed super fund. So a few general lending points for the self-managed super fund: you can get up to 80% loan. Okay, like I said, the owner of the property is the property bear trust itself. As long as while there's a loan there, the owner is not actually the self-managed super fund specifically, it's the corporate trustee of the property bear trust. But the borrower for the loan is still the self-managed super fund, because ultimately that's the holding, that's the legal owner, okay, or the beneficial owner down the track. Once the loan's paid off, the ownership transfers back to the self-managed super fund without any stamp duty consequences. There's specialist lenders in the self-managed super fund space. I won't touch on that, but essentially the big banks don't do it anymore because it's not really profitable and it's a bit more complex compared to individual loans. So there's specialist lenders in the self-managed super fund space, all very big financial institutions. So there's not much, you're not adding any specific risk, by not going with any of the big banks. It's just that these guys specialize in self-managed super funds and knows the ins and outs of self-managed super fund lending. And then let's only look at the self-managed super fund scenario itself. So essentially, they don't really assess your personal financial position unless you want them to in order to get a higher loan. But in essence, they only look at what's coming in of the self-managed super fund and what's coming out of the self-managed super fund to obviously assess your self-managed super fund position. Okay, so your personal assets and liabilities don't really come into play unless you want to get higher servicing. And then you go with a lender that can actually take into account your personal circumstances to lend you a bit more money to the self-managed super fund. So strategies, there's certain strategies that we can deploy if your fund balance is a bit short. Just say if you're short by $20,000 to acquire property, what can you do? So essentially salary sacrifice is by far the easiest and most tax efficient way of putting more money into your super fund. Okay, so essentially salary sacrifice, you can actually claim a tax deduction. Okay, so if you put in $10,000 into your self-managed super fund or your super fund in general, then you can claim that $10,000 as a tax deduction in your personal tax return. Okay, and it makes sense because the super rate for tax is only 15%, whereas if you're earning 100,000 or thereabouts, you're paying close to 30 to 40% in tax. So it's a guaranteed tax saving. Okay, but because it's such an attractive proposition, the ATO or the government puts a limit in terms of how much you can put in every year. And that annual limit is 27,500, including your mandatory employer contributions. Okay, so if your employer pays you $15,000 of super contributions every year, that means you can only put in 12,500 of concessional contributions, in which you can claim a tax deduction. The other avenue is non-concessional contributions. The non-concessional contributions, essentially, it's not tax deductible, so it's not as tax efficient, but you can put up to $110,000 every year into your super fund as a non-concessional contribution. Okay, and if you really have a big lump sum that you wouldn't want to put in into your self-managed super fund in order to buy a property, you can actually bring forward 2 years worth. So at any given point in time, you can actually put in $330,000 per member into your self-managed super fund. If you do that, it just means you can't make another non-concessional contribution for the next 2 years because you've already used it this financial year. Okay. So just to finish off, in terms of numbers, what are we looking at? How do we actually make it work? So just say you're in the market for a property that costs about 600,000. So how much do we need? So 600,000 cost price. If we add on costs at stamp duty, legals at 4%, that's an additional 24,000. So you need 624,000. Just say you have a deposit. Okay, just say you have a deposit of 25%. That's 150,000. Add the 24,000. So essentially, you need give or take $174,000 in order to purchase a $600,000 property. Now, this example is obviously very general in nature. Okay, so the bank will obviously need to assess a few more factors like where's the property located, how much is the expected rental income of the property, obviously how much you're making in terms of employer contributions going in. So this is a very general example, but it gives you a guide as far as how much you need in order to acquire a certain property at a particular price point. Okay, so certainly in summary, I mean, self-managed super funds, obviously a very big topic, and a lot more people are setting up self-managed super funds to buy property because they're actually aware of the property market, feel they're a bit more in control. Okay, and ultimately, because it's such a long-term asset, hopefully in the long term, once you do retire, it's going to generate a bit more capital growth, okay, for your retirement. These are my details here. Any questions, feel free to contact, but I hope you found the presentation beneficial and have a great day. Thank you.